India's economic growth declined to a 6-year low of 4.5% in the July to September quarter. The gross value added for manufacturing shrank by 1%. In other words, Indian companies cut production. This is a demand-driven slowdown, a relatively new phenomenon seen in India. One of the best tools to stimulate demand remains the monetary policy. Hello and welcome to the Mark to Market show. Mark to Market is Mint's analysis column where we look at market moving trends and news. My name is Pallavi Pengonda and joining me today is my colleague Aparna Iyer. Hi Aparna.
Hi.
Today we are here to ask some questions and give some answers on the monetary policy. So over to you Aparna, why is the monetary policy relevant?
That's a loaded question, Pallavi, but apt. As you said at the beginning, this is a demand-driven slowdown, and monetary policy is perhaps the best tool to stimulate demand. So to that extent, yes, the markets will watch what the RBI will announce on Thursday when its monetary policy committee makes its vote public on interest rates. And a rate cut is a given, considering the GDP slowdown we have witnessed over the past few quarters. But the most important question the market is asking is whether this is the last of the rate cuts that the RBI will offer.
So if there's a demand slowdown, why do you think, Aparna, that this will be the last of the rate cuts?
So the RBI has to abide by an inflation target which is given to it by law. The target is 4% consumer price inflation with a 2% leeway on both sides. So to that extent, we know that food inflation is on an upswing in the last few months, and that makes it complicated for the RBI to justify a series of rate cuts. And also policy rates have been cut by a massive amount of 135 basis points over just 10 months.
So the rates have been cut by 135 basis points. Why is there a demand slowdown? Shouldn't that have helped stimulate demand?
Very true, and here comes the biggest and perhaps the oldest hurdle of lack of transmission. Now, transmission to bank lending rates to market rates has been low, especially in terms of bank loan rates. The transmission has been extremely poor. But this, as I said, is not new. Banks are loath to cut loan rates even in the past. But this time, even bond markets haven't responded to policy rate cuts in a big way. The yield curve is at its steepest in 9 years. So clearly, companies are not able to borrow at a cheaper rate even from markets or from banks. In fact, because of the crisis in the NBFC sector, credit flow to a lot of segments in industry has collapsed. So the biggest challenge for RBI at this point is to instill trust in the markets so that companies are able to borrow at a cheaper rate, and the credit flow is unclogged again.
So quickly, Aparna, one thing which will happen on Thursday is that there is this expectation of rate cut. What else should one watch out for when the RBI meets next on Thursday?
So on Thursday, when the MPC puts out its resolution statement and its vote on rate cuts, obviously a rate cut is expected. Secondly, markets will watch out for whether the RBI will lower its GDP forecast for FY20. In the last policy in August, the RBI had already lowered it to 6.1%, but at that time they had assumed a Q2 GDP growth of 5.3%. And we know that Q2 GDP has come out much lower than that. Inflation forecast will largely be left untouched. The most important part of the statement would be commentary on credit flow and how the NBFC crisis will be dealt with. So economists are expecting the RBI to offer some explanation on how the credit flow will be unclogged to the industry, and also a broader statement on financial stability.
Thank you so much for your time, Aparna. So that's what is in store on Thursday. The MPC meeting has begun and the vote will be made public on Thursday. That's all for today on the Mark to Market show. Do stay tuned to know what happened on the policy outcome.